Good evening, everyone. Time for another silver update. You are looking at the 1 minute gold silver cross, and it's actually a chart that is, well, let me go ahead and show you how to pull this chart. You start out by pulling, actually I pulled gold, so pull that first. And then you just go to more instruments and you pick silver spot US dollar, and then you choose overlay. The reason you choose overlay, even though overlay is not accurate because it's just fitting the top and the bottom inside of the chart, relative to is more accurate, but you can't change the time frame, so play around with it yourself. I get a lot of questions. It's netdania.com that you bring these charts up. So you do this overlay, and I was actually going to do this video to show you that there have been a lot of critics saying that the silver price has not responded as the gold price has, and actually we had a very interesting day today where gold got slaughtered and silver recovered. And of course, in the time since I decided to do that, which is 8 o'clock Eastern time here, gold has rallied $30. So the observation I was going to make has become somewhat obsolete. But if we pull out a little bit here, we can see prior to that spike we were getting a rally in silver. That doesn't really show up there. Let's go further out and see if we can find it. Yeah, so it's not really showing there. This actually shows you more the divergence of gold pulling away from silver, and believe it or not, just a little bit earlier in the day today they were starting to come together, but now you can see gold is starting to race away again from silver. So these are wild markets. They do what they want to, and they do it very quickly. If you go right to the gold chart, you can see we've had just insane movements in price. Believe it or not, this last smackdown here from about when we touched above 1920 into new all-time highs, and then they brought out the Swiss franc, unbelievable Swiss franc scam to basically bankrupt all the people of Switzerland, and I had said Luxembourg, is actually Liechtenstein, are the two countries that use the Swiss franc. So basically to bankrupt those nations to support the Euro project, which is teetering on the brink of complete collapse. But they managed to, I don't know how they managed to do it, whether they blackmailed the Swiss or whether they own their politicians, or whether they, obviously with the various regulations that have come down on Swiss bank accounts, and you'll have to research that yourself, but the Swiss were compromised in their regulations a while ago under the Patriot Act. But now with this pegging of the Swiss franc to the euro, we've got a, I would term it an emasculation of the Swiss franc at this point. So back to that chart. Well, let's pull up the US dollar Swiss franc. You can see we've kind of flatlined there. The 1 minute show, well, the 10 minute gives a better, that's a relative flat line. It's the Swiss franc and the dollar. So they've kind of pegged the Swiss franc to the dollar, which is kind of strange. And a lot of speculation is going on as to whether or not this is some type of emerging world currency, because if you think about it, if they bring the Swiss franc in and they peg that to the euro, and then they somehow get some kind of dollar euro peg, then they've kind of locked up the West in a way into kind of a Western currency. That of course leaves out the East, and a lot of people have mentioned on my comment section that the supposed enemy of the inflationary banksters, the Swiss franc, has now been reined in and defeated. But in reality, I think that you'll probably find, if you examine it, that the enemies of the inflationary banksters in the West are probably in the East. So it's unlikely that this last move, I would say this is the last move in the reining in of the Swiss bank. You know, the BIS is based in Switzerland, so I don't see this as being some kind of move that goes out of the way and brings in a new thing, because ultimately the breaking of the back of the Western banks is going to come from the East in Asia. It's not going to come from someone in the West like Switzerland. Nevertheless, this is a unprecedented and incredible dramatic move that they have done to peg the Swiss franc to the euro. So you can see that peg is pretty much holding, and that's one more safe haven that is gone. Now, if you remember, I made a prediction when this happened that I thought that the cup would be formed and rise. That's actually this area. And let's pull up a volume chart to show you on gold. This is gold volume, so I don't know the accuracy of this volume. 10 million, is that 10 million contracts? I have a hard time believing that we're trading 10 million. Is that ounces? I don't know. So if you do know, let me know. But this is our period here where we had a breakout into new all-time highs. We had the announcement of the Swiss pegging to the euro, the crash in gold, the subsequent rally, and then you can see we actually had a massive crash, a follow-up crash based on this volume here, which is actually much larger than the volume that came in. So, and that's that 4 o'clock spot right there. So was this follow-on selling that occurred? My prediction was, of course, and I'll show you in the lines, and the reason I'm bringing this up is to show you that I can be wrong, because people were very quick to point out, to say, hey, you're wrong. Well, I admit I was wrong. I thought we were going to do one of these. Obviously, this volume that came in right here counteracted my prediction. So that's correct. I was wrong. Somebody stepped into the market and violently sent it the other way. Am I surprised by that? No, I'm not surprised at all. We also had a violent move to the downside. Again, a follow-up move. So we're holding this pattern, although we've just recently broken this. This is just in the last couple hours we've broken through this downtrend. So again, we're going through crazy financial times here. They're pulling out all the stops. I'm still sticking with my prediction of Bank of America going bankrupt within the month, and they're doing all they can with that. It's crazy. The times are insane. You can't even keep up with the news as it's coming. And if you remember, if you were in the gold and silver markets and just following the financial markets back in the time frame of mid-July through mid-October of 2008, if you remember that time frame, the news was coming so fast and furious, it was literally impossible to keep up with the bailouts, the bankruptcies, the scams, everything that came. And we're seeing that sort of thing happening with the wild volatility in the stock market and gold. So it seems to be signaling a large event that's coming. And of course, we know that the president's going to be speaking tomorrow, and he's going to be announcing some kind of jobs program. I read a quote today, I think it was on Zero Hedge, that pretty much summed it up. It was a brilliant quote that describes Keynesian job creation, and this gentleman said that essentially the Keynesian job creation system is like trying to fill a pool, a swimming pool, by taking a bucket and filling it up at one end of the pool, walking down to the other end of the pool and spilling some on the way, and then pouring it back in. So think about that analogy a little bit. That's an excellent analogy of how the government has the ability to create jobs. It has none. it could possibly enslave people like China, but it really has no ability to create jobs. So I wanted to look at tonight's topic, and I came across this because I was going through threads on Zero Hedge, and a number of people had pointed out this concept of financial repression. So I wanted to cover this real quick. Now, this topic has actually become back in vogue. It was a topic that was, and I'll read you this Wikipedia on it, but to go to the article that made this become a modern discussion was when Bill Gross of PIMCO came out and said that he sees a potential for financial repression in the United States. So we want to look at this idea of financial repression because I think it's a very good potential alternative to what we might be seeing coming down the road. So let's start with the Wikipedia article, and I'll read that to you briefly. It's just a general explanation just to give legitimacy to this. So this is Wikipedia. This is common knowledge, of course, because it's on Wikipedia. Financial repression is a term used to describe several measures which governments employ to channel funds to themselves which in a deregulated market would go elsewhere. Financial repression can be particularly effective at liquidating debt. Now, obviously, if you remember the crisis we went through in the summer with the raising of the debt ceiling, and now we're going to have Obama speaking tomorrow about creating jobs, we're kind of bouncing back and forth. We're back into that stimulus, austerity, we're going back and forth. Doesn't make a lot of sense because they're kind of polar opposites. So how do we walk that line between stimulus and austerity? So obviously, if you think about it clearly, there isn't any way to do that, but this financial repression concept kind of addresses that, and that's why I wanted to cover it. So they explained the 4 elements of financial repression. These are covered here in Wikipedia, and I'm going to go to an article that really digs into them. And number 1 is explicit or indirect capping or control over interest rates, such as on government debt and deposit rates. Now, I think you'd probably agree that we've seen that. We've definitely seen it on the short end, as Bernanke's come out and announced that for 2 years they're going to peg them to virtually nothing on the short end. But we've also seen it on the long end, and that's where it gets a little bit more sticky because the government and the quantitative easing, which supposedly ended in June, but yet there's this mysterious buying of the long bond. We just recently dipped below 2%, so obviously there is explicit or indirect capping of both short-term and long-term interest rates. So definitely have to say on number 1 we have a check. Number 2 is government ownership or control of domestic banks and financial institutions while placing barriers to entry before other institutions seeking to enter the market. Well, we're seeing banks go bankrupt day after day, or I'm sorry, week after week, on every Friday being brought under the umbrella of the FDIC. We also see a lot of machinations now trying to bail out Bank of America. So it does seem that this second principle is very close to being in place. Number 3 is the creation or maintenance of a captive domestic market for government debt, achieved by requiring domestic banks to hold government debt via reserve requirements, or by prohibiting or disincentivizing alternate options that institutions might otherwise prefer. Now, are we seeing that? Well, there's a lot of debate, and you can see on Yahoo debates about Social Security. We know that the Social Security Trust Fund has been looted and filled with government bonds. We also can see that, or at least I can see, and I haven't covered this in a video, but I'm seeing a lot of signs that the 401k market is starting to move towards some type of required government bond holding. So I would give this one maybe